Good afternoon, ladies and gentlemen. Thank you very much for joining us today. In light of recent market turmoil around Britain's unprecedented vote to exit the European Union, what the media is calling Brexit, we felt it was a good time to reach out and share our perspective. So thank you very much for joining us and welcome. Um, my name is Joe Anderson, and I'm a certified financial planner, president of Peer Financial Advisors. And there's my picture. There I am. And basically, if you're new to our firm, which most of this is probably going out to clients, but if you're new to our firm or if you only registered investment advisor, we manage just under $1.5 billion of client assets. All of our advisors are certified financial planners. We have locations in San Diego, Irvine, and Los Angeles. So basically, here's the agenda. What I want to go through is what the heck is Brexit and what does it really matter? How could Brexit affect the U.S. markets? What impact could Brexit have on the global economy? And how could it affect the U.S. economy? And what should we be doing? Should we make any changes to anything at this point? So let's start by taking a step back and asking, how did Britain get here in the first place? To answer that, we have to go back in time and take a look at some history of Britain and the European Union. Britain originally voted to join the European Economic Community in 1973. In 1975, Britons voted to remain within the new European community, which then becomes the modern European Union, and that was in 1991. Economic and political circumstances have changed dramatically since the 90s, and British citizens demanded a new national referendum on the EU membership. The issues at stake were complex and involved British trade, regulations, immigration policy, just to name a few. Ultimately, the vote was about this. Did Britain see a future with the EU, or did it want to get out? As we saw, British citizens voted to leave. So how is it going to affect the markets? So the vote was pretty surprising to investors around the world. And what did they do? They reacted by selling. This is not an unexpected result because markets hate surprises. They hate uncertainty. History tells us that recent market movements are probably an overreaction in response to fear of uncertainty. If we look back, we see that since World War II, when there have been political shocks like this, markets tend to oversell and then rebound in weeks and months to follow. That could mean that stocks are done tumbling. However, that doesn't mean we're trying to predict the future. We can look at similar events to guide us. During the crisis around the Japanese earthquake in 2011 and the European debt crisis in 2012, markets experienced double-digit losses and then recovered within 3 or 4 months. Will that happen this year? There's no way to know. While political events like this rarely have a long-term effect on markets, we should also keep in mind that 2016 has brought many geopolitical challenges to our door and headwinds are getting a little stronger. We should expect a lot more volatility going forward with a lot of headline risk. Headline risk is what we call it when markets overreact to media coverage of events. We can also think of it as the Chicken Little syndrome. We'll talk more about what investors should do later on in the presentation. But let's just talk about the political impacts of Brexit on the global economy. All right, in Britain and Europe, a lot of these risks are political in nature. In Britain, it's possible that this vote will splinter the United Kingdom. Northern Ireland and Scotland both voted to remain in the EU, within the EU, and they may vote to leave Britain in order to rejoin the EU. Britain also faces new elections in October once current Prime Minister David Cameron steps down. You can bet that negotiations around leaving the EU will play a huge role in the elections, and it'll probably get pretty messy. Exit negotiations are also likely to drag on for months and possibly years and be the source of a lot of political footballs. We can expect plenty of volatility in the financial markets as these negotiations are hammered out. Economists also worry that Britain could lose a lot of multinational corporations who rely on access to European markets and free movement of European talent. London right now is the center of Europe's financial world, and the loss of those financial firms would be a major blow to the British economy. The fallout of the Brexit could be enough to push Britain into a recession. Europe has several key elections coming up in Spain, Italy, and France that could be affected by Britain's vote. We'll be watching these elections carefully. One of the big worries expects that if the Britain's vote will be the first of many anti-EU votes that could cause a rush to the exits by other EU member countries. Britain leaving is complicated enough. If a member of the EU currency union like the Netherlands or Greece left, negotiations would be even more complex. No one really knows what the breakup of the EU is going to look like, but it wouldn't be good for global economic growth. I also want to point out that many economists are a little bit more upbeat. They believe that these doom and gloom scenarios are unlikely to play out. Since Britain and Europe need each other, further negotiations are likely to be favorable to both sides. European leaders are also a lot more likely to make needed reforms to keep the citizens happy and avoids Britain's fate. So let's talk about here, how could this affect the U.S. economy? Well, that really depends on how the divorce is negotiated. Again, there's no consensus among economists, but here's what we do know. Trade with Britain accounts for about 31 basis points, 0.31% of U.S. gross domestic product, GDP. So British problems with trade won't necessarily affect us. We don't foresee any structural changes to the U.S. economy as a result of British leaving. Some companies and sectors will be more affected by others, particularly those that have more revenue exposure to the UK. We could see an effect on their corporate earnings. However, the dollar is often viewed as a safe haven in times of international turmoil, which is pushing the dollar's value up versus other currencies. A stronger dollar may weaken demand for U.S. exports, which may drag down economic growth. Because as our dollar goes up, right, our stuff is more expensive, and other countries will not purchase it because it's more expensive. We should keep in mind, though, the fact that the U.S. is a consumer-driven economy and that wages, the housing market, and improvements in personal finances all support consumer spending right now. Will the Brexit be enough to push the U.S. into a recession? We get that question often. That's not really likely, though it could contribute to weak growth in the next couple of years. We think a major factor will be whether the market turmoil is enough to have a negative impact on business and consumer confidence. If so, we could see a greater effect on the U.S. economy. Britain's vote will likely affect Federal Reserve policies this year. If you look post-Brexit, expectations of a rate increase this year have gone down tremendously, where predictions of a September rate hike were at 30% before the vote. Now they stand at about 0%. In fact, some experts even suggest that rate cuts may be back on the table if economic growth slows. So, what should we be doing right now? First of all, you got to tune out the noise. We're going to see a lot of terrifying headlines about this, and it's not going to be good for your mental or financial health to be glued to the media. So let us try to filter out the news for you and communicate what we feel is the most important pieces of the information that's out there. Second, you got to focus on your financial goals. Do you know who isn't exiting the EU? America isn't. Now, political events don't change your goals, and it's critical to avoid emotional reactions. When markets stumble, the smart move is to sit back, take a look at the fundamentals, and make prudent changes when necessary. We'll be in touch personally if we decide we need to shift your overall strategy. Third, regardless of which directions markets go, we can expect a bumpy ride. Fear and uncertainty are going to rule the markets for a while, and stocks may tumble even more. Please do not panic. It's too soon to tell what this is going to mean for the markets long term. No one can agree on the probable outcomes just yet. Though we don't think the Brexit is going to be the end of the world, we want to acknowledge the risk it poses to markets. So, I guess long story short, there's different things that you can potentially do with the overall portfolio. We're here to help you. Right now, we're doing we're looking at tax loss harvesting, to making sure that if there are some losses in some positions, we're taking advantage from a tax perspective. Maybe we want to relook at some Roth IRA conversions. But over the long term, this is not it will probably be just a blimp on the screen over the next 2 to 5 years. I wanted to get this information out to you. If you have any more questions, please feel free to contact me or any personal financial advisor here at our firm. We are here to help you. You can always ask a question at info@purefinancial.com. So hopefully I just wanted to spend just a few minutes to kind of give you a rundown of what we're thinking here and to get the information out to you as soon as we could. Hopefully you enjoyed this. Like I said, if you have any questions, feel free to contact us directly. All right. Hopefully you found this enjoyable. We'll talk to you real soon.